Welcome to Theo Trade. This is Don Kaufman. June 5th, 2020. Minutes left inside of the trading session on this Friday afternoon. Here we are doing the weekend update with the S&P futures up some 78 handles. That's good for 2.5% move on this Friday following the employment situation. I mean, listen, is this a game changer for the markets, this explosion to the upside? Or is this going to provide the short opportunity of a lifetime in the markets moving forward? First and foremost, we're going to explore a little bit about what we saw in terms of trade this past week. More importantly and more appropriately, we're going to talk about forward risks and what we can anticipate, not to mention a few trade setups in this weekend's update. First on the docket, the employment situation. Yeah, we do have a situation. What I'm talking about is the jobless numbers that came out this morning. If you missed it, well, you didn't miss all that much other than the explosion of the marketplace to the upside. Okay, I mean, that really ignited the S&Ps, the analysts, and economists. I mean, they missed the employment situation by the broadside of a barn. I'm not even going to go into the specifics because it was that far off. If you're kind of curious, and again, it's no laughing matter. No, it really is a laughing matter at this point. Okay, they were looking for like over minus 8 million. And I'm not getting into too many details over here. Instead, we were positive over 2 million. When you say you can't hit the broadside of a barn, welcome to today's analysts. All the technology, all the know-how, and you can't even get within 10 million, all right? I mean, how many people are even in the workforce over here? And again, you can't even get within 10 million there on terms of the estimate. They couldn't have been more off. But I have to tell you, there's some good to this and some bad. So the marketplace, when they saw the jobs number, which again was supposed to be the most historic losses of jobs ever, ever. Not since the Great Depression, like literally ever, was historic. And the irony is it turned out to be the most historic number in the opposing direction. It's the largest creation of jobs in any month ever on record. And the market loved it, So the market explodes to the upside, obviously, on that news. But here's where the bear in me, the ever the cynic, I got to ask the question, though, is that going to drag out instability within employment? Big portion of me thinks to, in this situation, I think we actually wanted and would have accepted a really hideous number. So if we had actually gotten the minus like 8 million, the marketplace was anticipating that with stride, and we may have still gone up a little bit. The fact that we got plus 2 million tells me that it's going to be strung out a little bit. And again, why would I have wanted the 8 million? Because it's just like rip it off like a Band-Aid. Let's just get it over with. Let's see some horrible numbers. Now that we're positive 2 million, what it tells me, as a trader, I'm not an economist, not an analyst. What it tells me as a trader is there's actually going to be bigger instability into the future. And that analysts are clearly, they're so far off base right now, it doesn't even matter. So it's going to very likely drag out instability within employment. Now, the other big question with the employment situation, many people may or may not be aware of this, but there's a Fed announcement coming out next week. And my question in this, and this is why I say it, is this a game changer to the upside, or could it be the short of a lifetime? The Fed, my interpretation, and again, strictly my interpretation, the Fed, there's the closing bell. The Fed might not be, as accommodating as the marketplace would have anticipated. We're going to see some more, again, accommodation. Again, next week, Wednesday, the Fed is going to come out with an announcement. And this is where, once in a while, it's worth taking a little bit of a look over at the calendar. No one, there's an FOMC meeting, the FOMC announcement. Then Jerome Powell is going to have his press conference here right on time there on June 10th. Nevertheless, what you anticipate out of them is to be more accommodative. Not a question that they're going to be more accommodative, but okay, at this point in time, they're very likely to kind of taper things down to see if the economy can actually stand on its own 2 feet. And what a wonderful time to do so after having seen such a wildly bullish, jobs report. And there's just no two ways about it. Again, the Goldilocks situation that actually brought us within 200 points of an all-time high in the S&Ps. Come on, people. We're stone's throw off the all-time high. If you look at the year-to-date percentage, the S&Ps now are only down 2%. They're only down 2% on a year-to-date basis. Okay, that's why I'm saying you got to decide for yourself if this is going to be a little bit of a game changer or of a short of a lifetime. I'm going to show you a couple of trades here in a few moments. But again, you have to kind of love some of the risk reward that's being presented to you. You talk about like a V recovery. Nothing speaks to V recovery more than the marketplace itself. Nevertheless, okay, you have to be fairly concerned about, again, how the marketplace is going to interpret this wonderful jobs number. All of a sudden, the Fed starts to taper. And again, the Goldilocks scenario that we're seeing right now, okay, may not necessarily exist, which, again, I'm going to come back to here in just a moment. Before I get any further into this, okay, we got to bring up the SPX. I call this anything but normal, right? Now, we're gonna take a look in a few minutes at the SPX options chain itself. And we're actually going to dig into the expected moves here in just a moment. But before I do so, when I say anything, okay, but normal, one of the things that we've tracked extensively here at TheoTrade is when the expected move, okay, is either closed inside of or, for example, breached. And this week is just a massive breach. And I want to zoom in for a second because I recognize this is maybe a little bit difficult to see on the screen. But when I say I want to zoom in, okay, we'll zoom in very, very tightly to a period of time. Okay. And this period of time, it's, again, we're actually looking into September, October, November of like last year. And what I wanted to show you in here is, look, we closed inside the expected move, inside. These highlighted candles when we close outside the expected move. Okay. So here's outside. Everything else that you see on the screen right here is inside the expected move. And this is a period of incredible efficiency inside of the marketplace. And when I talk about efficiency, okay, the marketplace is quote unquote getting it right. They're just getting it right. And we actually went through a period of just week after week, we closed inside the expected move. And then we actually went through a period of just absolute hideous turmoil. One of the points that I continually make, though, when we actually hit the patch of turmoil, here's a move outside of expected. And that's actually back in early January. I'm putting some spikes on here. This one's actually, okay, starting into February. It was a spike outside. Here again, this is the third week in a row. Spike, to the upside inside of expected move. And we were just, that's a move outside. This is a move outside. And all of a sudden, okay, things completely and utterly fell apart. All of these circles right now, all of them are moves outside of expected. Okay, then again, we actually contracted for a period of time. Now, bear with me for a second because I'm going someplace with this. After all of these wild moves outside of expected, here we are, once again, the last couple of weeks. This is a move, again, inside the expected move. So we had 1, 2, 3, 4, 5, 6 weeks inside the expected move. Last week, we breached. This week, okay, we're 2 times the expected move. So what you're starting to see, and what this very well could be, is coming back into a period of wild inefficiency. Now, people are like, well, it's going to the upside or it's going to the downside. It doesn't matter. It does not matter. Okay. And I'll tell you why it doesn't matter, because what we're going to really project here in a moment is whether we should be a premium buyer or a premium seller. And this starts to really set up a lot of the trades that I've been doing. Okay. And a lot of the trades that I have been doing, they paid off, especially the back spreads, because we're ripping through the expected move. So in this week of trade, and I want to give you a quick reading on the SPX. The SPX, okay, closed at 31.93. I mean, we're closed right now, right? That's the SPX is closed. That is an $81 move. Today is an $81 move. And the interesting irony is that all of this past week, again, the week just literally ended 5 minutes ago. All of this past week, we were looking for a $78 move. Okay, today alone, we got an $81 move. What does that tell you about being, okay, a premium buyer or a premium seller? It says, listen, okay, these little hash marks that you see on the screen, and this is so important to understand this, right? These little hash marks, okay, this is where the week started. We're looking for a plus $78 move or minus $78 move. We don't get it. We move up the $78. We sit there today, we explode. We're exactly at 2 sigmas, which is literally 2 times the expected move, right? So if you look at a deviation curve, last week we were just outside, right there. We were just outside the expected move. This week, we're clear out to 2 sigmas, okay? This is once again becoming Mr. Toad's wild ride. And it doesn't matter what you think about directional bias at this point. It just matters that we're having what we're going to term here, and you'll see in a moment, outsized moves. Again, it's one of the most critical things to understand in context, some of the trades that I will place. So before I go any further, so we just had a $78 expected move. We smashed through it by double, right? You're on the verge of what? $160 type move inside of the marketplace for the entire week. If I go over to the trade tab though right now, one thing I want you to see, okay, and this should resonate with you now, this expected move right here, that is not set yet. This is for next Friday. It's not set yet until 15 minutes after, okay, after the cash close. The SPX options technically are still trading here, even though the SPX, okay, is what? SPX settlement happened. The SPX is not moving. The SPX options continue to move. But the point that I'm making here, okay, is with about 160 point move in the SPX, do you realize that next week the forward risk is still, okay, about what it was last week? It's about $78. What gives? You know what? I don't even bother asking that question. All I have to understand is this, okay? We just moved $81 in a day, and you want me to believe that we're only going to move, okay, what, $78 all next week? I'm sorry. I'm not selling that, okay, with my money, with anybody's money, okay? I am a buyer of the expected move. And in many cases, that could mean, you can go out and buy an iron condor if you wanted to. I'm not telling you to run out and buy a straddle because that's an expensive proposition in here. But things like buying iron condors and so forth is absolutely on the table. But instead of me just, blanket, do it in the SPX, I'm going to give you some trade specifics here momentarily. Okay, so the SPX, again, just smashes through the expected move. And it means a lot because if we continue to smash through these expected moves, it's going to provide unbelievable setups. And if we don't, it's going to be nominal amounts of risk. Let's actually cruise over to the bond market, okay? The bond market. We are so very back, baby, okay? The bond market is back in play. What am I really referencing? Well, on a couple of fronts over here. Number one, okay, volume inside of the options, that's inside of the ZB, is big. But take a look at the bond volume itself. Okay, you're seeing right now about 450,000 bond contracts that traded. All right, time out for a second. For those of you that are brand new in here, you've never necessarily tuned into one of our TheoTrade kind of weekend, updates. The bonds have actually been trapped like a rat in a cage. All right. Now we believe that the Fed had a huge amount to do with this. The Fed, okay, just kind of stabilizing the bonds. The Fed was just continually in the marketplace and it staved off all traders. How do I come to that conclusion? I come to that conclusion not just on the price action. Price action secondary. Come to that conclusion is, look at this. Nobody wanted to trade him. Nobody wanted to trade him. Like, you want to trade against the Fed? They go, hell no. I'm not trading against the Fed. You want to trade against the Fed? Okay. It looked like we were headed into the what I term the Japanese scenario. In Japan, okay, the Bank of Japan was so heavily involved inside of their bond and notes that the notes and bonds stopped trading. When I say stop trading, there was actually a day a few years ago where one contract traded in a day, one, not 100,000, one, and then the next day there was actually zero. Literally, they had zero, and it's still very, very light there, okay? But I wanted you to see, okay, the volume just completely dissipated, and look at this, okay? It's coming back, and what that's going to do is it's going to start to break the S&Ps free of also their incredibly tight range. Listen, I put huge amount of weight into the bond market. Now, the bond market here is telling you something. And this is probably one of the most important aspects of the entire week that no one is paying attention to. Listen, everybody's like, the S&Ps, they're up. Yay. Clap, 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 clap. They're missing the fact that, listen, right there, okay, that was what? Right before the employment report. Right here, okay, that's actually the end of the trading day. What do you got? The bonds are ever so slightly higher. Okay, the bonds may have just reversed course. If the bonds reverse course and head back up, what's it going to do? It's going to crush the XLF. What do you think just took us to these levels? What do you think just took us back to the levels that we're at inside of the S&Ps? Okay, we've been harping on this for weeks. It's all about the financials and all about the monsters of tech. But this rally was brought to you by the financials. Plain and simple. Okay, the bonds got crushed over the last couple of trading sessions, right? They broke the range. Okay, but the issue with this is the rates out there. This is the TNX. By the way, the TNX is the 10-year. Don't confuse it. It's not the 30-year, but I much reference the 10-year. Okay, the rates took off from roughly, okay, earlier in the week. I mean, they're like 0.7%. Now the rate's actually 0.9%. This is the mother of all moves inside of interest rates. All of a sudden, interest rates take off to the upside. Yeah, we're going, okay, into a recession, or in a recession right now, with rates exploding to the upside. Since when has that been, okay, viable for a marketplace? You're like, no, it's all about a recovery. Okay, I'm trying to help you answer the question. Is this a game changer of a short of a lifetime? And I'm telling you right now, the bonds, okay, are the keys to this. Because you have Fed influence, and the Fed is trying to keep those rates incredibly low. Doesn't seem to matter. The bonds are actually selling off over here. But, okay, the bonds retraced, and not too many people caught that. And as the bonds started to rally, the interesting irony is it did not necessarily have negative implications. Did not have negative implications to the financials. Keep a very close eye on this in the next week of trade. Because I'll tell you what, if the bonds, if they even, again, smell the idea of going higher from where they are right now at the 173 level, again, I'm going to stress this again, they even smell the idea of bonds going higher. Okay, they are going to go after the XLF. They're going to sell it because that, again, this entire rally in the S&P, everybody's like, it was brought to you by the financials. Yeah, and the financials were brought to you by none other than the bond market selling off. Okay, next, onward and upward, outsized movement. When I'm talking about outsized moves, okay, we're seeing some wicked expected move breaches. And what this means, everybody's like, it's a recovery, it's this, it's that, okay? I could care less. As a trader, what I'm looking at in here, when I talk about like outsized moves, right, I'm going to apply this auto expected move. Now, you know that the SPX shattered its weekly expected move, which means the spiders shattered the weekly expected move, okay? The IWM shatters its weekly expected move. But if you want to know where the epicenter of all of this trade happened to be, again, look to the financials. Look how far out. I mean, the financials, the upper edge of the expected move is supposed to be about 24, 23, okay? They started the week in the neighborhood of 23.40, okay? What were they expecting? Oh, 23.40 up to what? 24.20. So you're not looking at a huge and massive move, and all of a sudden, we end up on the week at what? 26.24? You're looking at 3 and 4 deviation type moves. Needless to say, we had, okay, our back ratio spread in here, right? Our back spread was in here. It was positioned, okay, expressly for that type of explosive movement. Because the argument that we made, and I'll tell you the exact date and time, we made that argument right here. Okay, and I'll actually show you exactly why I made that argument. Clean up the chart for a second. We're going to zoom out. We made the argument based on the fact that the XLF is inside of an incredibly tight range. Right here at the bottom of the range, we said, listen, if the markets are going to go higher, they have to do it on the back of the XLF. It's one of the points that we made, okay, a couple of weeks ago on this video, on the weekend video. And sure enough, we've exploded to the upside. The back spreads paid out beautifully. Now, we had back spreads inside of the XLF, okay, but we also carried back spreads where? Okay, other products like XLE, which happened to be none other than the energy sector, which was also waffling towards the bottom of the range. But we also carried back spreads in none other than EEM, okay, which was also waffling towards the bottom of the range. It broke out. Okay, we also carried a back spread specifically inside of the bonds themselves in the TLT. Okay, when the bonds were actually towards the upper end of the range, we were looking for the bonds to break the lower end of the range. Again, most of my trades, when I actually show you that, yeah, we made some money in the XLF and the XLE and the EEM, I'm going to tell you forthright, most of those trades were hedges for me against the fact that I'm actually carrying short delta. Let's not forget, okay, that I am actually carrying bearish positions when the S&Ps are up 2.5%, and you're able to weather the storm when you have hedges, especially, okay, when we have movement this far outside of the norm, okay? And again, when you're looking at like the TLT, apply it like the expected moves. You're like, wow, that's just, I mean, it's ridiculous, all right? Again, anybody could have gone out and bought premium this week on almost every single product that you bought premium in. You would have made money, which is exactly the next point. I'm a premium buyer. I'm going to continue to ride that pony, okay, until it can be ridden no more. I want to be a premium buyer in this marketplace. I make that, known because a lot of people, no, you must always sell options. You must always sell options. And I'm telling you right now, I'm a premium buyer because it's working. Do you know how many back spreads we've hit inside the last couple of months from IWM? Okay, I mean, it started really when the market sold off an XLU, right? Product like an XLU when it crashed to the downside. We made money in IWM to the upside, to the downside, the XHB. We've been hitting this, these infinity spreads on both sides of the marketplace. And now the ranges, okay? We've had ranges in the bond product. It's broken. We've had ranges in the dollar. And again, it's been a while since we've actually covered anything about the dollar. Okay, but it's critical. And again, I'll actually show you. Look at the, by the way, the Euro US. Okay, is that wild enough a move for you? Again, it's not every single day that we're looking at the dollar, but I wanted to show the Euro US dollar. But when we start talking about the range inside of the dollar, it shattered it. Okay, the dollar range is shattered. The bonds, that range is shattered. The SPX, okay, which we term the volatility box, it's shattered, all right? But here's one interesting opportunity, gold. And in this case, I'm actually going to go cruise over to GLD. This range, to me, is still very much intact. And I think that this is a great opportunity. In fact, I'm going to display very specific trades in here on Monday. Again, inside of the GLD, I'm going to look at very specific trades for you because gold is still inside the range. Okay, this is like one of the products that just hasn't cracked out. It's going to the downside, it's going to the upside, doesn't matter. We're actually going to cover our basis here inside of gold coming into Monday and trade. Again, the ranges have been cracked. I still believe that there's a phenomenal risk-reward ratio to be had here. The market is going to pivot based on what the bonds do at this point. I am strongly inclined to believe that any more sell-side activity inside of this bond product, strongly inclined to believe any more sell-side activity in this bond product is going to be met, okay, with Fed rhetoric, and they're going to knock those bonds back up. If they pull those bonds back up to lower interest rates, okay, they're going to damage the S&Ps in the near term, okay? The Fed is coming out this week, okay? They're already in a quiet period. They can't talk now until Wednesday, for the first time you hear Jerome Powell, okay? Bonds are going to be edgy. You're coming into another trading week. Expect quite a bit of volatility. And I'll reiterate the stance. If you take a look at the SPX and you look at the SPX expected move this past week, we're looking for like a $78 move. You get almost a $160 move. Okay. This next week, the marketplace is looking again for about a $78 move. And you have a Fed announcement coming in here. Look for a move outside of expected. And we're going to position a couple of trades specifically for that. Thanks everybody for joining us here at Theo Trade on this weekend update. Have a wonderful weekend. Bye-bye.